And so welcome to this session. And you have 4 papers. And so as I said, I was thinking to divide the slots into mini slots so that every paper has got its own mini Q&A part. And so you have about 22 minutes overall, meaning up to 15 minutes for presentation, up to 7 minutes for Q&A. Then it's up to you in a way to allocate its time. Okay, so let's start. So Matthias Goldmann from EBS is the first speaker. So Matthias, please, the floor is yours.
Good morning. I'm here to talk. Thank you very much. I'm here to talk about industrial policy. I think you can hear me much better when I'm here, right? It's the problem ceiling. So what I'm going to talk about is industrial policy and sovereign debt. This is how it works. What we see, this is an overview. I'll just at first talk about the return of industrial policy, then give 2 historical examples, and then I'll go to the 2 main parts. One is sovereign debt risks arising from industrial policy. The second main part is industrial policy risks arising from sovereign debt crisis. So it's just reversed before I conclude. So much to the overview. Now, the return of industrial policy, is it really a return? Well, industrial policy defined as support for individual industries rather than macroeconomic measures has been common or was commonly developed and developing countries up until about 1980s. Then it fell out of favor in advanced economies. And what we now experience is not really a return because some countries like China have always sticked to it and have had it for the past 50 years. But what we now see is just here an example of the EU and US, a really forceful return of industrial policy. And if you look at these measures, and I don't really want to go through them, what you see is that, first of all, it's relatively independent of who's at power, whether it's Trump or Biden. There might be differences in the measures. There might be differences in the industries that profit from it, but industrial policy is really back on the agenda. And what we really see is, if you, for example, look at the EU, is that it concerns areas that are crucial for the future of developed economies, microchips, raw materials, batteries, sorry for the missing T, all that stuff, infrastructure in general is really crucial for our country's economy, so that industrial policy is really key of this de-risking state, as Daniela Gabor has called it. Okay, this is not at all new. We have to face the fact that the industrial policy was crucial to the rise of developed states. And I'll just give one example from my country here, Germany. Germany's industrial rise, Germany's rise in the late 19th century as a leading industrial power, overtaking Great Britain, is due first and foremost to the establishment of a railroad system. That happened in the different German states, like before there was one German empire. For example, Prussia designed a railway plan in the 1840s, and it handed out government licenses to companies which were mainly funded on the capital market, sometimes with seed money from the government, and sometimes with seed money from banks. If the banks went bankrupt, there were public bailouts, and so on and so on. In smaller states, you had direct public funding, direct industrial policy, and all of that was bailed out in a national plan or in a nationalization plan in the 1870s. You may remember that there was this crisis called the Great Default in the 1870s, which Germany came out very, very well because of all the public funding it provided. And at the end of the funding line was the Reichsbank that voluntarily accepted both sovereign debt and private debt. It was actually a system of monetary financing, which many people in Germany don't want to hear these days, I suppose. Now, here's an example to the contrary. Egypt in the 19th century also began with a very ambitious plan of industrial policy and societal reformation under its leader, Mohammed Ali Pasha. Was really a modernizer in the best sense. And part of and parcel of that was the Suez Canal. It was actually a project brought to Egypt from the outside by a guy, a French diplomat called Fernand de Lesseps. Sorry for the missing capital. What went wrong with that? And they ended up founding a joint venture, the Compagnie Universelle Maritime de Suez, a joint venture owned by Egypt and by themselves, and most of it should be sold on the market. Most of the shares should be sold on the market. The shares were having a coupon of 5% per year, which is quite an ambitious rate, I would say. 30% of the shares did not sell, therefore Egypt had to buy them. The Egyptian state had to buy them to realize the project. Then construction began in 1859. First of all, they had to invent all these machines. Very expensive. Legal challenges also abounded. The Ottoman Empire was not happy with that. And a suit caused additional costs. So £7 million accumulated even then. Then a catastrophe happened from an external source. The US Civil War ended. Cotton production resumed in the United States. Cotton prices fell. Egypt lost a lot of its export revenue. Therefore, it had to borrow. It borrowed from banks at coupons that were of 7%, that were selling at the nominal rate of 80 to 2.5%. So you had a huge discount already. Yeah. So you can calculate what the interest rate was. It was actually much higher than 7%. So in 1873, we were at the position where Egypt spent already 2/3 of its revenue on debt. Yeah. And then ultimately 2 years later, it had to fire sell the shares to Great Britain for a fraction of the price that it eventually had held, which didn't help Egypt to avoid this debt restructuring known as the Caisse de la Dette Publique, which became a foundation of Egypt's colonization, right? So, and that's the opera, yeah. But if you read reports of this Suez Canal episode today, you will always find Western commentators, European commentators, blame Egypt for basically spendthrifting on things like the opera. I did the math. The opera cost £100,000, which is a nice sum. But the Suez Canal cost dozens of millions of pounds. So it's absolutely clear which was the cause of it. And if we add all the revenue generated by the opera AIDA up until this day, I think we get a very different calculation. So it's not that these barbarians overspent, but it's actually that they were talked into a project which they could not afford. Yeah. So this is basically the problem of industrial policy and its relationship with sovereign debt. So there are sovereign debt risks emerging from industrial policy. Industrial policy can be very promising. For example, the United Arab Emirates just announced a 35 billion investment in Egypt, especially economic zone, and everything looking very promising. That can be great. But we also have a recent example of things going totally wrong. Mozambique's tuna bond story, where they invested in ships that were actually delivered but never could function, never could fulfill the purpose for which they were aboard, and this ending up in yet another contemporary default story. So what are the risks? We've got business risks. The investment as such might be bad, it might fail, like the tuna bonds, where the business plan was one page for an investment of hundreds of, like the initial investment I think was 700 million. Yeah, it's absolutely incredible that this would ever work. And of course there are borrower risks, corruption in all its different forms, whether it's explicit outright legal corruption or implicit corruption in the terms in the sense of political favors. So borrowers might over borrow because someone might get some of the funds, like it happened in Mozambique. There's also a lender risk, as in case of Credit Suisse, overspending on or extending a credit that shouldn't have been there. Why? Because that credit promised a nice revenue, which they couldn't get in more serious business. Another credit risk or another risk on this part of lenders is lenders that get a collateral for the project they're investing in. I think everyone here in the room knows about collateralized bonds. And of course, there are macroeconomic and geopolitical risks. And this brings me back to the Egyptian example. What happens if prices drop all of a sudden? What happens if there's a war and tourists can no longer go to Egypt? Yeah, all of a sudden, Egypt is in a terrible problem, and its economic outlook will turn to the worse. Price drops or price rises, we're not safe from that anymore these days, and all that can pose sovereign debt risks. So what can you do? There's many things that one can do from an economic side, and I'm eager to hear about that. But what I'm interested here is rules for borrowers, rules for lenders. What do you have to do, like, in order to prevent this from happening. And here are some like very general rules which I'm trying to narrow down, to concretize into a set of more substantive principles. Those rules are the right to self-determination of a government or of a state, of a peoples. Human rights obligations of states, economic, social, and cultural rights, for first and foremost. Well, we have got already some more substantive rules with the principles of responsible sovereign lending and borrowing. And I also think that environmental agreements, such as the Paris Agreement, need to be in focus here, because much of the industrial policy nowadays is into green industries or into energy transformation. So that is also a rule that you somehow have to keep in mind. And what principles, guidelines, I would say, can we squeeze out of these rules? Well, one of them is, if we take self-determination seriously, then any investment should be based on a national industrial policy strategy. They need to make their decisions what they want to have. Due diligence, of course, is basically a no-brainer, I would almost say. Another thing is full transparency. You need absolute transparency about the business projects and about the funding structure, so as to enable people, maybe people on the ground, to raise a flag and say, well, hey, we didn't find any votes here, or there's a dam supposed to be constructed which has not been constructed. Yeah, so transparency helps here. It's also all included in these instruments. Another thing are debt restructuring clauses, where you say that some of the risks that might happen on the way of such a project, that actually typically happen, give a favorable restructuring clause. Like, for example, what happens if there's a price drop? What happens if there's a certain exogenous risk like war? Wouldn't that be a reason to include in the contracts a restructuring clause? Yeah. Of course, you should also restrict collateralization and fossil investments and enable green investments. Instead, one could talk about giving more favorable conditions to green investments. So that's the one side. The other and last part is industrial policy risks of sovereign debt crisis. So what happens with your industrial policy once you are in a sovereign debt crisis? Now, there is the problem that many countries that are in a sovereign debt crisis or a sovereign debt in a problematic situation concerning their sovereign debt, they might no longer be able to carry out industrial policies they want. We have serious tensions in the EU when Germany went ahead with its Doppelbums, with funding for, or with subsidies for energy, and all the other European partners, due to their much more difficult debt exposure or debt situation, could not afford the same thing. So you get a problem of competition. It seems like unfair competition. So industrial policy is key to future economic development, but if crises torpedoes successful policies, the situation might get worse. And this is why I think that debt restructurings need to take into account industrial policies. And so far, they don't really do it. And the key problem is really DSAs. DSAs are short-term, relatively short-term, whereas industrial policies are sometimes really, really long-term. They focus on the primary balance rather than on, something like future potential. Yeah. So the long-term prospects might vary greatly depending on your industrial policy. So they're defeating one of the factors that might turn the long-term prospect to the better. Of course, the problem with all that is we cannot simply change the DSA to take into account industrial policy, because there are good industrial policies and there are bad industrial policies. There is promising investments like the railroad in the 19th century. There's problematic investments like the tuna bonds, Saga. So how can we distinguish from them? There are some documents from the IMF where they are making some attempts. All of that is broad guidance. Again, I would say, and to conclude with that, we can go back to some rules, basically the rules that I said before. And the gist is, I don't think that international organizations should pick the good or the bad policies. Rather, we should again look at national industrial policy plans. If they follow all the principles that I developed before, and it was talking about sovereign debt risks emanating from industrial policies, if they're kosher, so to say, they should be taken account and they should be given a favorable treatment in debt restructuring. So there should be made an assurance that these policies can be continued. I'm concluding by saying that this is really an explorative research. There's much to be done here. There's only first documents, international documents, and we really need to think about standards for industrial policy. And so that which I've done here really insufficiently, I suppose that they will be mainly procedural rather than substantive, not identify concrete projects, but identify ways, concrete ways in which you come up with sustainable, supportive, and therefore trustworthy industrial policies. Thank you very much.
Excellent. You did very well in time. So, yeah, Carlo?
Very nice presentation, Matthias. So I have two questions. One is, so you're saying in the beginning, as in industrial policy may go to may cause sovereign risk, no? And so it's a big question, but is it, so is this, so it's the government taking risk?
Yeah.
Right, you do investment, it can go well, it cannot go well, then the investment is definitely.
Yeah.
Is that better? So, and therefore the government, the borrows and going to pay interest for it, and it maybe have a hard time to repay, etc. Is it better than the private sector doing the same? Because then I guess that's the question. If not, it would be the private sector that suffers same problems. And so, I mean, I don't know what you think about that. And the second, when you said DSAs don't really look at, very long-term industrial policy, but do they really not? What about, I mean, I guess they think about growth rates, no? And so I guess for growth rates, I guess the investment must be aware that just primary purposes are not enough to change, to get the country back to growing, etc.
Yeah.
Do you want to keep collecting? You prefer to answer? Because I see.
Okay, we can collect.
Okay. So,
which is really in line with this. So I think the IMF looks at growth, prospective growth, and it tends to be over optimistic. And that's that we brand down about that and done research on that. So that's but so in a way it goes a bit against. I mean, the bias tends to be the optimism and not the pessimism on the critics. So I know how to spread that.
Fernando?
It's in the same vein, but have you thought about possibly linking the debt directly to the project, separating the regular from the regular debts that are issued to, say, the budget and the government? So make them project dependent. Yeah. Making the debt issuances directly related to the project, so therefore the investors kind of like have an equity cost that is different from the regular debt that the government issues.
Right. So I guess you can, unless there is any, but I don't see it. You can answer if you like.
Excellent question. Thank you very much. So the private-public question is heavily debated. If you look at industrial policy historically, you see that successful examples for both models. Yeah. It is not true that public investments are always bad. Take the example of Germany, take the example of China. And we know that there are inefficiencies and not that and I'm not saying that every Chinese state-owned enterprise is doing particularly well. But there are also in China, there are positive and negative examples of the same financing structure. So I would say, with that, whether it's private or public, it doesn't really matter so much. What matters is the same with private or public universities, but successful examples for both. What matters is really what plan is there, what transparency is there, what commitment, what structure, what accountability, and so on. So I think with a procedural approach, you can basically even gloss over that. And I would even, at the international level, not make a difference because we know that countries have very different property structures. Yeah, some countries just tend to have more a nationalized economy than others. So we should really make it depend on that. Both of them, of course, can fail. Now, the topic of growth rates, what they do is in the DSA, so this is my latest information, they have a calculation for 10 years. Yeah. Which might be fine from a financial policy perspective. And of course, it's more difficult to calculate the longer in the future you go. But we have to face the fact that many of the investments in infrastructure have a much longer cycle than this. So there's this mismatch of cycle. The second thing is that how do you calculate the growth rates? Of course, there's the optimism bias, so we know it's very, very difficult. The problem is that the input, the estimates are pretty much up for grabs. It's a it's a black box in the sense that much of it doesn't really depend on the country alone. Much of it depends on global developments, that exogenous factors that we cannot really take into account. I would be less concerned if there was an optimism bias concerning industrial policies, rather than if there was an optimism bias concerning, let's say, budgetary structures, but general budgetary policies, other factors that that you have to take into account in a budgetary policy. So the question is really, how do you account for potential future investments in that area, and if there's no fiscal space left for a country in its debt crisis, then there's just no way they can continue or even take up or begin a new industrial policy. That is a bit the concern I have. Like how are you going to start an industrial policy if you are already in a very difficult debt situation? You might attract foreign investors, but you cannot even give guarantees, because we've heard that this is a problematic thing to give guarantees. Plus, we cannot provide the backstop that industrial policies need when they get into a difficult situation. Yeah? So I would say that, even if growth rates have been exaggerated in the past, the question is, why have they been exaggerated? Yeah. I'd be eager to hear more of you of these factors that have led to an optimism bias. Mostly it was related to growth rates, but what's the basis of these growth rates? It's models that assume a certain cyclical development. Industrial policy is not really relying, or is not really affecting the cyclical development. It's a much longer term prospect that we are doing here, and I'm not so sure whether that is included if you only have a horizon of 10 years. Giving me some food for thought, and thank you very much for your questions and for listening.
Thank you. Okay, so now the second paper is presented by Carlo Galli from Carlos III de Madrid.
Thank you. So thanks a lot to you guys for putting the paper in the program. Thank you for the heroic presence at this time of the morning. Thank you, Silvia, for sharing. So this is a paper on inflation, default risk, and nominal debt. So I mean, it's about default because we are at DebtCon, and it's about inflation because I'm interested in fiscal and monetary policy. So the motivation is that in the last, by now, I mean, this is a well-known fact, last 20, 30 years, many large emerging market sovereigns started shifting a lot of their debt issuance and that stock to local currency, both domestic issuance and external issuance. Domestic more, but even external. There's a lot of local currency debt in the world right now. And so this, of course, brings up the new problem, which is that, local currency debt can lose values in two ways. One, through explicit default, but two, through implicit default, which is by inflation. If you depreciate or inflate away, then the real value of that for foreign or domestic creditors goes down, and that is a default. It's just another way to reduce the value of your debt. And so this strategic inflation, all right, so just the part of inflation that we think about when you want to reduce the value of debt, has the ex-post insurance benefits, because if you can adjust ex-post, now you have some state contingency. We know the state contingent assets are a good thing, you get insurance. But ex-ante, of course, creditors are not stupid, so they're going to make you pay for it, right? If you are expected to depreciate later on, you're going to have to pay a premium for it. If you depreciate in particular states of the world, you're going to pay more or less, depending on, pricing, etc. So here I want to study the joint behavior of inflation default spreads. So the premium that the government pays when it issues that in local currency for the expectation that it may default or inflate on this debt. Okay, so it's important to understand this because to understand whether we want government issued in dollars or in local currency. And also it's a first step in agenda to start to understand, monetary fiscal interactions, or whether you want the central bank to be insulated from the government so you can commit that you will not have the temptation to inflate, or whether it's actually useful to be able to do this, inflation adjustment ex post. So I'm gonna show you just a little bit of data where I use asset price derivatives that contain information on these two risks, default and inflation depreciation, separately. Okay, and that's nice, so I don't have to decompose bond spreads into the default premium, the exit bond premium, the inflation premium. This I can kind of find them separately. And so what I will find is that the common printing price argument, which is, for economists, so it's not necessarily that we believe it, but the printing price argument is that if you can print money, you never need to default, right? That's the story. Okay, we see, so I find that this is not really there. Countries with high default risk also have high inflation and depreciation risk, and vice versa. So even if if you do issue all your debt in local currency, it's not really true that people don't expect you to default because you can always print. And so I find the default risk moves with inflation, both realized and expected future inflation, and this holds in the long run across countries and in the short run within countries. Okay, then I try to make sense of these findings. So I take a standard quantitative sovereign default model where the key ingredients, the default is a binary choice, as is typically modeled. You either default or you don't, because there are fixed costs associated to default, so you cannot really default every year or every month. You default once, it will be default, and then next time it would be in many years. Whereas inflation is more of a continuous instrument. It's going to have some costs. So you don't always inflate all the time. It's going to have the benefit of diluting the value of real debt. And it's also going to have the benefit of generating senior revenues, right? So by printing, you can somehow raise tax revenues. That's why I guess the paper in this session. And so, this may be useful in some cases. So what I find is that if you forget about seniorage, so about raising revenues through inflation, then the dilution motive of inflation, so the use of inflation in order to default, doesn't really make the model work, because then inflation and default are substitutes, they do the same thing. So after you've defaulted, there is no reason to inflate because you already reduced the real value of debt. Whereas in reality, we find that inflation and default move, that Reinhardt and Rogo's work is that after defaults, we see a lot of inflation. So in the standard model, that doesn't work. So you need something else. And so what I propose is that, if you just very simplistically add that inflation allows you to raise taxes in bad times, in general, then you want to use inflation in bad times, which is when it's expensive to borrow, and then you reconcile the movement with these two objects. So let me show you some facts first. So I use the last 15 years of data when asset price data is available. It's 11 governments that are very large, the largest, and have free or managed floating exchange rates, so we don't have to worry about pegs and fixed exchange rates. And the average local currency share of total debt is 73% and above 50 for all these countries. If you just look at external, then this share is a bit lower, but it's still quite high, around 50 or more percent. The data that I use, so for default risk, I use credit default swaps. Okay, I guess you all know what they are. So the derivatives where an investor can insure against the default of a country. They are denominated in dollars, so they're based on the dollar part of a country's debt. So assuming certain assumption that default is not selected, which is an assumption, then this tells you the probability of default of a country and has nothing to do with the possible depreciation of the exchange rate or inflation upon a default, right? Because this is in dollars, so whatever happens to the currency doesn't matter. So it's kind of a clean measure of default risk, or as clean as we can. For inflation risk, I use 5-year cross-currency swaps. So I take Du and Schreger's work. So these are basically long-term equivalents of exchange rate forwards. So they give you the implied depreciation, net of risk premium, the implied depreciation of a currency. And so I interpret the interest rate differential, which is the implied depreciation, as expected inflation. Right? So I'm going to talk about inflation, but really you can also think about depreciation, exchange rate depreciation for foreign investors really care about the exchange rate, not really about inflation, but in the long run, they're not that different. So the first fact, and I really like this graph, it's a cross-country fact. So I take averages up to just before COVID, but if you include COVID and Ukraine, well, everything looks kind of similar. So here I plot the average annual default probability, which you can think as the average annual credit default swap spread. I mean, they're the same. And here, so here I have average 5-year cross-currency swaps. So this is 5-year depreciation expectations. Okay, so countries with low default probabilities on average also have low expected inflation or depreciation. Here I plot average realized consumer price inflation. And so you also see that countries with high average default risk also have average realized inflation. Okay, so countries that are in trouble on the fiscal side also typically tend to be in trouble, if you want to consider it trouble, on the monetary side. The second fact is by taking the time series correlation within each country. So these are all correlation coefficients. No causality, nothing, just want to see how they move together. So this is the correlation between default swaps and cross-currency swaps, so default and inflation risk. And the correlations, however you want to look at it, I don't know the possible specifications. Correlation is very high and always positive. You may think that these things move together because there is global risk. So the VIX is moving everything. I've done a dynamic factor model with autoregressive factors to try to purge away all possible global stuff. Then you take the residuals, you do a final regression, and you get that, you get very positive coefficient between changes in inflation expectations and changes in default risk. The standard errors are very small, so it's there. The correlation is there. If a country is in trouble for default, it's also in trouble for inflation and depreciation. Then I also look at correlation between default swaps and inflation or exchange rate depreciation, so realized macro variables. And the correlations are a bit smaller, but they're all positive, and some are pretty high. So the idea is that there is movement. So then I take a model and I say, okay, can we make sense of this movement with what we know, or if not, what do we need? So I'm not going to go into the detail, of course, for reasons of time, but so I take a standard quantitative sovereign default model in the tradition of Arellano and Goldmann. And so the ingredients are going to be that that is nominal, so it can be inflated upon or defaulted upon. Inflation is costly, okay, so there's going to be a quadratic cost of inflation with the idea that, if you inflate, you hit the citizens of your country because they hold cash and cash loses value, for example. There's going to be endogenous government spending, so the government wants to finance some level of spending. And there's going to be a government that is benevolent and want to maximize household utility as a standard, domestic households as a standard, and foreign lenders that lend to the government, charging a premium for default and inflation as a standard. So this is just a setup. The government maximizes the utility of consumption and government spending minus the cost of inflation. The government lacks commitment. All debt is external and nominated in local currency. So it chooses the debt, it chooses inflation, it chooses lump sum taxes, and this is very important, and it chooses spending. Okay, so inflation, as I said, has two functions. It can reduce the value of debt, so reduce how much debt you have to repay in real terms, and generate revenues, which I model with the reduced form function sigma. So the more you inflate, you have some cost, you have some benefits, which are of two types. Then the taxes are the important part. So the lump sum taxes can either be unrestricted, which is going to be the baseline model, okay, and this brings you back to the standard quantitative framework, so Arellano, etc. Or they could be constrained by a fiscal limit, okay, which is very, very simple upper bound on taxes. And so what's going to happen in a nutshell is that when you cannot use lump sum taxes freely, then this function of inflation is useful. If not, you don't really care about this, you just think about inflation as a default instrument. Okay, households that receive an exogenous income, they pay their taxes and they consume. Pay their taxes and they pay the seniors because they're the ones holding money. So yeah, I have this, but I was not planning to show them. Just lenders very quickly. Lenders are risk neutral as usual. They have an opportunity cost of fund. They price future debt, expected default, expected repayment tomorrow divided by expected inflation, expected default tomorrow divided by expected inflation upon default. From the price of that, in the model, I can back out the default probability, which is the expected value, the expected probability that the government defaults. And I can back out the model equivalent of cross-currency swap, which is the expected inflation tomorrow. So the results, as I said, in the baseline model, I assume this upper bound of taxes, which I call tau bar, It's never binding, so you can use lump sum taxes as much as you want. And the utility of government spending is equal to the utility of private spending. So basically, what's going to happen is that the government is going to use lump sum taxes to finance spending always. Seigniorage is not going to be useful because seigniorage has a cost, because inflation is costly, whereas lump sum taxes have no cost, there's no distortion. So the purpose of inflation is to inflate that away in another way. So what's going to happen is that in this model, as I said before, inflation and default are substitutes. So if default risk is high, cross-currency swaps in the model, so expected inflation is going to be low. So I get that the correlation between default and inflation spreads is negative instead of positive. So the model in standard factually gives you the opposite of what you would like to find. And the reason is that, so these are policy functions as a function of output in for three different levels of debt. Okay, so green is high debt, blue is small debt. I should have a legend. So inflation incentives are counter-cyclical. You want to inflate more in bad times because it has more value. But this is the crucial part, that policy is very pro-cyclical as in all of these models. So you issue a lot when you can, because that's when default spreads are low. It's cheap to borrow, so you borrow a lot because the government is impatient. So because that is pro-cyclical, then expected inflation follows that a lot. And so equilibrium default spreads go up in bad times, but inflation spreads go down in bad times, and so you don't get this correlation. In the alternative model, I assume taxes bind, so the tax limit binds, and I assume that the public good utility is more curved than the private one. So you have a strong incentive to raise taxes in bad times because you want to keep level of spending sort of constant. Okay, the justification of this is that fiscal capacity in emerging market is typically low, so taxes are not that ample an instrument to collect revenues. And so in this model, what happens is that seigniorage becomes a very useful instrument to collect revenues in times where other sources of funding are expensive, which is when times are bad. So default spreads are high and borrowing is expensive, right? Because earlier you could use seigniorage or taxes, now you can only use seigniorage or borrowing. And so when borrowing is expensive, you don't use it. So in this model, what you get is that there is a wedge between the marginal utility of consumption of the private and public good. So the model works. So I managed to get the correlation between default and inflation spreads as in the data. Default spreads are counter-cyclical as in the data. The data are not that counter-cyclical, but we know this is kind of the numbers we're looking for. And you get that inflation and default risk, also realized inflation and default risk, co-move together. Okay, and the reason, yeah, I'm done. This is the last slide. Sorry. No worries. Thank you. So what happens is that the incentive to inflate becomes more counter-cyclical. That policy becomes less pro-cyclical. So the dashed lines are the new ones, and the shaded ones are the old ones. And so the default spreads don't really change, but the expected inflation changes completely because the incentives to inflate in order to raise revenues in that time become much stronger. Okay, that's, I mean, it's pretty simple, the intuition. There's not really much more than that to it. And so this works, and it is one way, of course, not the only one, to get this movement to work. And so I leave you with a conclusion. I show in the data that inflation and default risk and realized inflation, they all move together. In a model, it's hard to get this. If inflation is only a way to default, you need something else that gives you a bit of counter-cyclicality in inflation incentives. So that's it. Thank you very much.
Okay, thank you.
For the questions, Carlo. Thank you very much. Very good presentation. Could you have done it with distortionary taxes? I guess that's one of them. The other is, could you explain a little bit more why the realized inflation is lower on the model with the tau bind relative to the especially during bad times? I thought I was expecting that you were going to actually use the model, or maybe that's the case in the simulation that higher adiabatic higher inflation model with tau binds.
Sorry, you said why realized inflation is lower?
Because the
In this model?
yes, like the fact that the shaded ones, yes, are actually flatter. So
Okay, yeah.
You're actually gonna have fewer inflation when quite is low, less inflation quite low.
No, you have higher inflation.
Sorry,
The dashed is the new model, the constraint model.
okay.
So you have lower borrowing. So I reply now because you have lower borrowing, higher inflation in bad times. This lower inflation in good times because that doesn't go up as much. Because and that's it.
So basically, my question, just looking at this now, is are we hanging out in the same area at their body? Or because this is also functions, so it's not obvious that we are making the same debt level choices and therefore the single portfolio.
So I target the average, and so that's the same in the two models. The variances change because now the fact that it's kind of the point of the paper is to understand how the spreads move. The fact that the spreads move means that now in bad time it is very expensive to borrow because you pay 2 premium, not 1. Before you were only paying really 1 premium because the other premium was very low. Now, because creditors know that you have an incentive to use seniorage in bad times, then they charge you 2 premium. Therefore, borrowing is more expensive, so the volatility of that goes down. And so in a sense, you don't want to borrow so much in good times because it's going to hurt more to have a lot of debt to refinance in bad times. And this is sort of intuition. Yeah, this is what we're after.
Yeah. Matthias?
Thank you. Just two excellent presentation. 2 conceptual questions. First of all, you spoke about tax limits that derive from budgetary constraints. Is that correct? I'm struggling to understand that. Second point is your model. You're assuming a non-committed government that is not committed to inflation. Now, we know that in reality, how does that match with the idea of independent central banks? We know that in reality there might be less independence than in theory, but are you basically assuming that banks are not independent in that model? Okay.
And then Martha was
a question on the framing of your model. I don't know if it's complementary or necessary explanation, but when 30 is the kind of the dot which that both high muted inflation and high. So is it a model of Erdogan basically in bad institutions, there was South Africa as well, where you can fire the finance minister and the central bank governor as he wants, and so that explains that you have the movement of default risk and inflation, or South Africa or in Nigeria where the reverse new president that fires central bank governor, which was leaving the inflation. So can it match, can it complementary with political explanations?
Monica?
Great presentation. Want to ask, if you thinking about restricting our government spending, because you have the tax limit, so what it will be implications in some fiscal deficit rules and things like that?
And Andrea?
I'd be fasting.
That is a fascinating paper. I think what you're finding is when it rains, it pours. So it's kind of typical Reinhard statement. So bad times are bad and basically. And I think for me, I like this world-class model. The one thing that I would like to see is the difference between international and domestic investors. Because my hunch is that first you try to expropriate the domestic ones, and then you go to the international ones. And I think by doing this, you're shifting the default structure.
Okay.
You had a question too? Awesome.
Okay, thanks a lot. Very happy to see you are engaged. So Fernando, you asked me one thing earlier.
The distortionary taxes.
So yes, you can do the distortionary. Suggest sure. Absolutely. That's what you want. The tax limit, yes, this is just an assumption that you can't tax above a certain, tax cannot go above a certain tax rate, right? Which is basically the same as saying that the Laffer curve for taxes has a limit. Okay, so the justification for it is that some of these countries, maybe there's a lot of tax evasion, and tax evasion is not independent of the tax rate. Now, suppose Argentina is very travel, taxes go to 50%. People just say, you know what? That's okay. I get it. Central bank dependence, yes, absolutely. So the point is actually these countries are doing quite well in terms of central bank independence. You still find the data that I showed you are for these countries. Of course, there's an argument that Turkey, for example, does not have such a very good central bank. So that's another possibility. You could say, look, I want to write a completely different model where central bank is actually independent and is correlations come from somewhere else. I think they're kind of complementary. I tend to believe that there is a little bit of temptation to do what I described, even if central bank is independent, because perhaps not that independent, but possibly some of the things that I described in the empirical part come from another story, not the central bank is completely sold to the government. I mean, this not the central bank and the government want the same thing. So they don't have really a conflict. But the central bank doesn't really care about controlling inflation, only up to the point that it doesn't create costs. By institutions, yes, probably. But it's still a question for a macroeconomist if a bad institution still wants the good of the country, probably, or the good of the government. So does it make sense that investors expect both inflation and default risk to move together? I mean, you could still think, if really the central bank is the slave of the treasury, why would the treasury ever default? Right? Maybe the treasury is saying, guy, look, print more. Right? Instead, we really see these things move together. And I mean, to me, it was kind of a curiosity to understand whether there was true or not. But yeah, I mean, clearly it looks like so. Restricting spending, you can do it. I have, the useful government spending, so it would be bad because you cannot adjust it. But you could. I think you can get everything with exogenous government spending if you just get the stochastic spending moving in some ways. Domestic versus externals. Yes, I think that would be very cool. It's also very complicated because then you have to think about selective default and do the domestics have the same pricing function of the foreigners? What happens to domestic default? You hit the financial sector, blah blah blah, versus hitting foreign hedge funds. Sure, that's probably a better idea. There are a couple of papers that do that actually, and are very cool. So I think I definitely agree with it. That's very important. Thank you.
Okay, thanks. So the next paper is presented by Monica Tran-Xuan. Sorry, I don't know if it's semester from University at Buffalo.
Okay. Thank you for coming at such early hours, and thank you for including my paper in the program. So today I'm gonna talk about debt sustainability. I've been talking a bit, but thinking about also on a redistribution perspective. And so the motivation that I have with this research is I've been really thinking about. I think we have been thinking about what kind of policies we should respond during debt crises, but also thinking about like the distributional consequences of these policies. So if you think about when you get into debt crisis, you want to try to raise some taxes, lowering some transfers programs in order to raise more revenue to repay debt. Usually those kinds of policies often affect more on the people on the lower side of the income distribution. And so I want to think about sort of like a bit more of on a theoretical side, similar like a framework that thought about these sort of tensions between sort of two competing goals, right? So on one side, you have this sort of commitment to thinking about if you have high inequality in your country and you want to think about distribution, you think about distributive policies, that's sort of like your commitment to your domestic agents. But at the same time, that may actually interfere with your commitment to repay debt, which is more like your commitment to your international lending, right? And more like motivational facts is that if you actually look at whether or not these sort of tensions or trade-offs are actually relevant. So it tends to be that, right, we talk a lot about global imbalances, rising in debt over time. So I'm just kind of plotting here debt and also income inequality. This is more like pre-tax or pre-government policy inequality. And you can see that there's sort of a long-term rising trend in both sides. And I'm sort of presenting here more of a average across a lot of countries. I'm gonna focus here more my quantitative work on this paper here is going to be focusing more on the case of Italy, also see, but that also applies to actually many countries as well.
So Monica, so let's aggregate external debt.
Yeah, so focus is I'm going to focus on net foreign liability, so more your net external position of your country.
Okay.
Yeah, so there's many definitions of debt. I'm going to focus more on that. So in this paper, I want to ask a question. So it's whether or not, right? I'm kind of motivated, it matters, and I hopefully to convince you that so ask right whether or not if you have a motive for distribution, does it matter, or maybe it doesn't at all, for like whether or not your willingness to like sustain your external debt, or your net external position, and whether or not your policies or your fiscal policies are going to change, taking into account like that you actually care about wealth. And so in order to answer these two questions, I'm going to have frameworks. Gonna be 3 key ingredients here. I'm gonna have that people are so more like a theoretical framework. We're gonna have that people are different in labor skills. So you think about high skilled workers versus low skilled workers. We're gonna have taxes. So it's a debt and tax session. So I'm gonna have taxes here gonna act as policy for distribution, but they come with some distortionary costs. And the last key thing is going to be key here is that the government cannot commit to any of those policies. So think about cannot commit to both of the tax and the debt policy. And so in terms of the contribution, I'm going to argue here. So before I try to argue, I think my contribution is not about why countries want to accumulate debt, but rather to think about given that you have some debt accumulation and you want to do debt commitment maybe because of industrial policies, whether or not people are willing to lend you, like your lenders are willing to lend to you. And I'm going to argue that the fact that you have some sort of commitment to your domestic agents buy some of that commitment even abroad. And so it's actually you want to sustain debt. I'm going to explain more why that will be the case. And so that in a way generates some sort of, there's some costs that are associated when you default on your external commitments that stems from this fact that you have inequality and you have redistributive policies that are expensive, right? And so this is a little bit in contrast, complementary to the literature in which the other reasons why you don't want to default, or the reason why you have cost of default, or you want to sustain debt, maybe because you have long-term commitment, or maybe because you have some output or productivity costs, maybe right from trade agreements or like disruptions and things like that. So here's gonna be a bit more indulgent, right? And I'm gonna show you that this part, like when kind of trying to look into the data, is gonna be in a way being able to explain why countries want to sustain a large amount of debt. Okay. Yeah, so overview of results. So this is matching to the data for Italy. Is I'm going to show you that it can account for about 60% of what you observe external debt. And again, external debt is the net external debt position of the country. And can also show you that more like on a long run perspective, you see the rising inequality. This is pre-government intervention inequality. Is going to be able to explain also the rise in the that you see in the net external position of the country. And in terms of policy implications, like what would happen when like you get into a recession, you get into a debt crisis? I mean, actually, what turns out to be is that in the very short run, right? So if you get some sort of a recession due to like productivity loss, you're gonna try to raise a little bit of debt initially, in the very short run. That allows you to do a little bit of redistribution in the short run. But however, in the long run, so you're gonna see this trade-off that in order for you to repay the debt, you're gonna have to actually sacrifice your distribution. Okay, so I'm gonna skip the literature. So I'm just gonna have one slide of the model here, right? So I already kind of explained a little bit, right? I have different households in the economy. You can think about high skilled workers, low skilled workers. They care about consumption and labor, so they make their labor supply decisions based on the taxes. I'm going to assume that these households are impatient, meaning it's a simplified assumption, meaning that it's actually cheaper to borrow abroad. So if you have a motive to accumulate debt from abroad, and I'm going to argue why would they want to continue doing so. just have a firm here that basically has some productivity, right? In the simulation, I'm gonna think about like the drop in this productivity is like sort of like during a recession that potentially during a debt crisis. They use labor for production. In terms of government policies, I'm gonna have a set of proportional taxes. So these are taxes on labor. So you can think about high skill, low skill workers. They make different amounts of labor income, and they get the same tax rate, but the higher income you have, the more taxes that you have to pay, and also lump sum tax as well. And then they, in terms of they can also make debt decisions and default decisions. I want to think about here in terms of credit markets. Here is going to be more unconventional a little bit, and want to think about actually thinking about state contingent bonds. But however, I'm going to think about that there are going to be scenarios in which the government cannot commit to repay these bonds. So it's a bit of more like endogenous incontingencies that's rising. Right? And the way I'm going to discipline or really thinking about the lack of commitment is that you can really think about some sort of a contract between the country and the rest of the lenders. If you really don't want to follow the policies that you said you do, then you get punishment and you get sent to an island, right? So autarky, which is basically that you don't have any access to like your external financial markets, like we're just still working, like basically get sent to an island. And so when I really think about this kind of contracting problem is really thinking about how much debt would you be able to sustain after all this? We talk a lot about debt restructuring, renegotiation. So you can think about this is really the amount that you really at the end would get after all of that negotiation, right? So this is like what would be the amount that after all this renegotiation, what would be actually the amount that I'm able to actually have? Okay? And in fact, actually, I'm going to show you. Yeah.
So both households and government can borrow. Both households and government
Yeah.
borrow from abroad.
Yeah, but
Autarky for both.
autarky, both of them cannot do anything about it, but they can exchange assets to each other. The government can issue debt within the country. And actually, I'm going to show you like this is a very simple example. I'm going to have a deterministic productivity, so just a constant productivity. I'm going to show you that when I don't have any inequality or heterogeneity, actually I cannot sustain any amount of debt, right? Because so like really thinking about from like an expansive perspective, or thinking about after all this that what would be the amount that I would get without having to renegotiate or anything? That would be kind of zero, right? And because well, any amount that I borrow, I'm going to default the next day. So from an expansive perspective, no one wants to actually lend to me, right? And a very simple domestic, that will be a zero, right? But what would happen if I have some heterogeneity? So gonna focus a bit on this graph. So I'm gonna plot to you here what happens if I actually try to default on the debt versus if I'm not defaulting on the debt. So red is gonna be what happened if I'm defaulting. But really what's going on is that, well, I have people are impatient. So I mean, it's cheaper to borrow abroad. So what I'm gonna do is that I'm gonna have some borrowing from the domestic sector. That's what I call domestic debt, but it's really debt owned by the, if you think about private sector, lumping all corporation, everything in here. And what really the government could do is that they could actually raise some taxes on this. So you can think about this more like a capital control tax that is curbing down the borrowing from the private sector, right? And this tax is going to have some redistributive benefit, right? Mostly is because you want to curb down the overborrowing of the private sector. But what it really does is actually have some redistributive benefits, because the rich household turned out to be the one that borrow more from abroad. They just higher income, so they have more leverage, so they borrow abroad compared to lower income. But what it does is that, well, it's a tax that really trying to curb the overborrowing, but then it has redistributive benefits. And because of that, I actually don't have to raise so much labor tax. Right, so, and so because I don't have to raise so much labor taxes, people are gonna work more, I'm actually producing more output. And so from an extensive perspective, my economy actually have higher debt capacity. So really thinking about here is like debt capacity. And so you can see that you would like to continue having this rising this debt capacity, and eventually over time, so eventually you're gonna get some amount of maximum debt capacity that you could have, and that really depends on like the inequality and also like how much redistribution you actually do and how costly it is to do so, like how elastic labor supply is. Okay. So I put it in the case of Italy. So when I go to the quantitative analysis, I add the usual. I add back the aggregate shocks. So if you really look at the no inequality model, I show you like in the example, it's like zero debt. Here there's still some debt, right? Because it's still you want to smooth aggregate consumption over time. So there's still a business cycle reasons about why you want to sustain debt. But as you can see, right, the quantitative cost of business cycle is actually very small. So the amount of debt that usually would like to sustain an equilibrium is going to be small. But once you add motive for distribution, you're going to have higher amount of debt. And actually also better at thinking about also the volatility of debt over the business cycle as well, much closer to what you would observe in the data. And again, debt here is the net external position, so it looks a little bit rather low compared to other kind of measures of debt. Okay. In terms of what would be the response to negative productivity shocks, so you get into a recession, more like focus here on the case. So the baseline is going to be blue, no inequality is going to be like dash dot black. You can see that in the economy with no inequality, you actually raise much more debt, but you actually have to repay this debt along. But in the economy with inequality, you actually much more slowing down, takes longer time to actually repay the debt. And that is because you kind of play around with this margin of inequality and kind of sacrificing some of your distribution. Okay. I have some cross-country empirical evidence, like this very broad to think about really correlation, as you observe that in the long run, high income inequality countries that have high income inequalities, like pre-government policies, are often positive correlated with higher debt, but also like low income taxes in the long run. And that's kind of like some evidence of the theme. And so I'm going to conclude here as to show you some new theory of thinking about debt sustainability that coming from this sort of domestic commitment to do redistribution, because it's actually very costly, and having access to external markets allows you to reduce, to basically allow you to do domestic policies in a lower cost, and that allows people willing to sustain that. And so in a way, ties in the two facts that people have been observing is this rise of global imbalances, but also rising inequality. Okay, thank you.
I find it really fascinating, this idea to tax borrowing rather than labor. I think it's an almost revolutionary idea that you include here in your model. Of course, we all know that politics doesn't work like this in reality, but I really like your model much better. Having said that, I was my question really relates to this initial graph that you presented, actually, I think on your first foil at the end, where you show that rising debt coincides with rising inequality. That is really fascinating, and yeah, that is it. And I want you to expand a bit on the process. Is that because, you know, as soon as that rises, repayments rise, and therefore there's less to redistribute? So the additional debt is not really used to redistribute and decrease inequality. Is that correct?
So, yeah, so here I want to clarify, I'm actually focusing on countries that have positive external position. So that's one thing. The second thing is, I'm thinking about this as pre-tax, so pre-government policies.
Yeah.
So this might be coming from, I don't know, like skill bias, technological change, or like rising education, or like wage premium. So really thinking about more outside of government sort of fiscal intervention of the rising inequality.
So this is total debt, this is not only public debt, or?
This is net foreign liability, so it's like net external position of the country. Okay. I mean, we've talked about like it's total debt has been rising much more. This is actually a bit more of a stable, right? But it has been
Total external debt, yeah.
yeah, but for very long term has been rising gradually across among a lot of countries. Definitely.
Right.
Sorry, I'm answering your questions. But so to talk about the tax and borrowing, I'm really thinking about here is capital controls. So really thinking about curbing on the overborrowing of the private
The
sector.
capital controls don't really generate any revenue.
In this framework, I'm a bit abstracting from the revenue because I have a lump sum tax or transfer for revenue purposes. The capital controls here are really curbing, but it has the redistributive benefit because it usually affects more of the richer households. And so that allows you to reduce labor.
So here, so in the model, it's a story. So you can borrow because you have inequality. Sort of, no, if I correctly.
You can sustain your borrowing.
Yeah.
Yes.
So do you think in the data that's what's happening, or there is just happens to be correlation between countries that have a lot of inequality and countries that have a lot of debt because there's something else driving both? Sorry, it's a vague question.
So that's what I did try to control in the very just broad empirical work. Is that I did try to control for all the factors that may drive both of them. You may think about like growth, maybe a factor that's driving for both of them, or just the level of development, or maybe inflation, things like that. So I did try to control both. So this is more like a story that is beyond the other factors that are driving, and just offers a theory of the story that can correlate these two beyond.
And so if you want to, can I?
Sure.
If you wanted to target Sweden instead of Italy, what would change what do you think would change most in the model? What parameters would the?
Definitely how much redistribution you want.
So taste for redistribution.
Taste for redistribution, but at the same time, I could argue that it's not too costly to borrow domestically. So you may. Like the differences between the interest of borrowing abroad and domestic is gonna be high. So in a way, you also don't want too much debt to begin with. So there's gonna be competing forces.
Yeah, if I might jump in here, so because you assume that the government is benevolent, I think, and so there's just concern for redistribution, but default, I mean, may not only increase the cost of redistribution, but also might have a direct impact on some electoral costs for the government per se. So I was wondering if you, I mean, consider some electoral concern that to me look a bit more credible than a benevolent government in the decision whether or not to default, for example. And also adding the fact that governments might have different preferences for a distribution, like left wing or right wing.
Yeah, so I'm definitely abstracting from that sort of political risk of like changing the taste for distribution. I would argue it probably gives you more business cycles, swings of things. I do find that even if you don't change any preferences for distribution, I do find that in bad times you do want to sacrifice redistribution. So I would imagine that, so you're thinking about like maybe that you don't want to do a lot of distribution, so there's not a lot of cost associated with it. But I have to think a little bit. I think the mechanisms is still go through as long as you care about some distribution that is instead of letting just I guess like competitive markets to kind of like decide like the kind of distribution. I think as long as you care some about distribution, or care about some groups of economies.
Okay, thanks. I think we have to. Maybe you can just discuss bilaterally. So we have Fernando Arce from Federal Reserve Bank of Chicago.
Thank you very much to the organizers for including my paper on the program. This joint work with my colleague Nicolas Werquin and Morgan was an excellent array. It's very important to say that some of my views are not the views of the Federal Reserve, because I'll be talking about politics. So this paper is about something that has been brought up in the panel discussions and also in the debate, which is that usually when we're thinking about governments and that are trying to consolidate the debt and avoiding a default, they talk about political constraints, what's politically feasible. And we don't really can do this tax reforms or this other reform because it will be politically costly, because we will pay an electoral cost. And one of the ways in which the governments pay a cost is because there are protests about a tax reform. And we tend to see this a lot. We saw it in France, but we see it also in emerging economies. Every time there is a large tax reform or a big substantial tax reform, there tends to be a lot of protests. Same is true for around periods of default. We tend to see a lot of political instability and social unrest during periods of default. And so far, the literature has been interested in political risk, but not so much on these notions of social conflict. And this is where we are trying to fit in. Why it's important to think about social unrest for sovereign debt as opposed to just elections? Well, protests are something that happen at a very high frequency. It allows the population to respond immediately to the choices of the government, much faster than an election, which have to wait 4 years to keep the people out of power. Protests are also costly for everybody involved. It disrupts the economy, it involves getting out of work for 1 day. It's not costless neither for the protesters nor for the government. Therefore, there has to be a strategic decision why to stage them, and also what the government always talk about, thinking about their choices to try to preemptively making different fiscal choices to prevent possibility of facing protests. And one of the things that the literature has shown, and that politicians want to talk about, is that protests tend to lower the re-election prospects of the governments in office. They make them unpopular, people don't like disorder, and we tend to see that there are drops in popularity of governments that face continuing protests. So we're going to try to embed all of these notions in a quantitative model of sovereign debt. And for that, we're going to have to have political parties, and we're going to have redistribution and two parties that have different preferences for redistribution and therefore heterogeneous households as well. And so it's going to be a model with a lot of bells and whistles, and unfortunately, I'm not going to have the time to go over it in detail, but I'll be happy to talk about bilaterally after the presentation if you want. So we're going to calibrate the model for Argentina. We're going to be able to generate the fact that both political and fiscal crises are going to happen in tandem. It's something we observe in the data as well. We're going to find that protests and default risk interact in two different and opposing ways that are actually interesting. First, we're going to find that protests can increase default risk by making it more likely that a political transition is going to happen by decreasing the re-election probabilities of certain types of governments. In particular, when we have a transition from a right-wing government to a left-wing government, these are going to be periods in which we're going to be more exposed to a default risk because right-wing governments are able to sustain higher levels of debt than left-wing governments. And this is going to be a challenge that's going to generate more default risk. And we're going to try to use the Argentina experience of 2020 to understand how this could work. But at the same time, protests can also penalize governments because households can protest during default episodes. They can potentially act as an endogenous default cost, something that a government would be afraid of doing defaulting because it will be worried about the process that are going to follow, and therefore they're going to try to commit more to repay the debt. We're going to try to see how these two channels operate. So I'm going to, in the interest of time, skip the literature review, but there's a lot of people who worked on this before. So let's go to the empirical motivation. So the literature so far has used this index of political risk, which exists for a broad set of countries and at a very high frequency. It measures notions of government stability, internal conflict, and socioeconomic conditions. It doesn't have anything to do with like fiscal deficits. It's purely same notions that we have here. So we're going to use this index in a cross-country regression to try to show that there is a correlation that holds between political risk and sovereign spreads, even when we control for fundamentals. But we're also going to build our own data set. We're going to build our own data set using a scraping algorithm for Argentina, in which we're going to go over newspapers articles in Argentina and picking up how many protests there are at the quarterly frequency. And we're going to link that up with the spread data for Argentina. So this is us replicating what literature has done. We use this index in a cross-country regression with quarterly fixed effects, and we control for fundamentals like the external level of debt, the current account. And we find that political risks is always statistically significant at explaining part of the CDS spreads at the country level. So some of the spreads that we're observing tend to be associated. Countries that tend to have high political risks tend to also pay a high political, high spread on the sovereign debt. This is another way of visualizing the data. Here we're focusing on an event analysis. We're focusing on an event in which this index of political risk increased by more than 2 standard deviations. Think about this as an episode of social unrest. And we look at, okay, so what happens with the CDS spreads around these periods? We tend to observe a spike as well on the interest rate spreads. And the model is going to be able to generate this type of.
Sorry, Fernando, just a clarification.
No,
But why don't you use directly a measure of civil unrest in the ICRG?
The measure of civil unrest in the ICRG varies very little. It's an index from 0 to 4. It's there's very little variation. Okay, so this is Argentina. This is Argentina from 2007 to 2020. The height of the dots is the number of events that there were, the protests that there were that quarter, and the size of the dots informs you about how many people were involved in the protest. We have the different presidencies of Argentina marked by the dotted lines. So these were 2 left-wing governments, and this is the right-wing government that took over in this specific period of time, and then a left-wing government took over again. You can see that there are more protests during the right-wing government of Madrid. There are also 2 default episodes that are around those dates, and that there tends to be a lot of protests during those defaults, but also immediately after the defaults. But there also seems to be an asymmetry between the number of protests that are right-wing government and left-wing government face.
So we're going to see 2016 as a real default.
Correct?
You're going to use 2016 as a real default.
Yes, we're going to use, actually, we're going to focus more on this one. We're going to use the fact that after 2016, there was a renegotiation at the very beginning of the Macri presidency that lowered a lot of the spreads. I'm going to use more the re-entry of that default than the actual default of 2016. So this is the Macri presidency, even like at the daily level, because we have the protest data at the daily level, and we're plotting this alongside the spreads. So you can see that at the beginning of the presidency, the spreads were going down. This is what I was talking with Carlo right now. The spreads were going down, but there were a lot of protests to the austerity measures that the administration was putting in place. Even though Macri was putting in place austerity measures that were much more gradual than the ones we're observing right now in Argentina, there were still a lot of firings of public employees and freezes on the government subsidies. As the situation started, as Argentina entered a recession, Argentina asked for a loan from the IMF, entered a plan with the IMF. There were also protests against that. And eventually, the spreads started rising, especially after lenders started realizing that Macri was going to lose the election. He did lose the election. A left-wing government was inaugurated, and in the first quarter of its administration, they immediately defaulted on the debt of that had been issued by Macri. So let's briefly explain to you the model in. Perhaps we could click on the flow chart. It's gonna be easier to understand the model in flow chart than with equations. Okay, so we're gonna think about this model as kind of like a game. So the government is going to be able to be controlled by two different parties, a right-wing party and a left-wing party. The right-wing party is going to prefer the rich. The left-wing party is going to have a preference for the poor. So that's going to be, they're going to be making different redistribution assumptions, but they're also going to be able to control the default and the debt and the tax decisions. Redistribution is not going to be costless in this model. So there's going to be an equity efficiency trade. If you want to split the pie more equitably, you're going to have a smaller pie. It's not going to be free lunch there. And that's going to also mean that if you put more regressive policies in place, you accept more inequality, you're going to be able to sustain a higher level of debt. The output is going to be bigger. Once the government makes the fiscal decisions, we're going to let the households play, and the households are going to be able to either accept what the government did or revolt against the government policies. Revolting is going to have a cost. It's going to lower the TFP, kind of in a similar vein as how the default also lowers the TFP. But it's going to have the benefit that is going to lower the probability that this government that you are in opposition to is re-elected next period, and it's going to increase the chances that a government that aligns with your interests takes power next period. But maybe we can click back. Thank you. So yeah, that's how what we do. And the lenders, of course, are going to internalize all of this. So the probability, the spread that you're going to have on your debt is also going to depend on whether or not a revolt took place that period, because a revolt is going to change the probability of who's going to be in power next period, and that has a big implication for the spreads. So let's go to the quantitative analysis. We're going to calibrate the model to Argentina. We're going to try to target the tax progressivity. We're going to sort the parties between right and left using this data set from the Inter-American Development Bank. We are hitting the standard moments of the sovereign default literature, the level of debt, the standard deviation of the debt, the spreads, and the standard deviation of the spreads. But we're also hitting a new set of moments that are related to the political cycles, the number of right-wing government, the share of income that goes to the top 50% of households before tax and after tax, the level of tax progressivity, and the level of revolts, the share of time that the right-wing government stays in power. So this is a simulation of the model at the ergodic distribution. The model is going to be able to generate these spikes in the spread when there is a high probability of revolt. So in the model, once the government makes its fiscal decisions, it's not going to be able to perfectly foretell if the households are going to revolt or not, because it's going to have a very good idea. It's not have an idea about the probability of revolt, because you can understand what the households are maximizing, but the households are going to have a small taste shock that can potentially take them one way or the other. So the government is going to make its fiscal decisions thinking about this, but not with perfect foresight of whether or not a revolt is going to happen. We could completely get rid of the taste shock, and we will still have some revolts. We will still have some governments that will say, I'll take the gamble. They can try the heavens may fall, but I'll try to do the tax reform, and maybe it will die out in a few periods. But we figured that the state shocks represent a little bit more how how governments operate under certain level of uncertainty. You don't really necessarily know how the streets are going to respond, and they also have to a little bit with the computation. So okay, let's try to unpack a little bit. Like the model works generally quantitatively what we were going after, but let's try to understand a little bit how it works. So this is a distribution of the tax progressivity based on what party is in power, and this is exactly what we expect. Right-wing parties are doing right-wing things, are putting regressive policies in place, and left-wing parties are putting progressive policies in place. So there's more redistribution here. What this means is that output is also going to tend to be higher when a right-wing government is in power and when a left-wing government is in power. And what's going to entail is that in terms of gross debt divided by average output, we're going to observe higher levels of debt when a right-wing government or a left-wing government. Here, it's very important, and it's a separation, a distinction between our model and the literature. Right and left are going to have exactly the same discount factors, meaning the same patients, but also they're going to have exactly the same exogenous default. It's not that one of them is likes to default more than the other. So we're going to keep them the same in that notion, and we're still going to find that left-wing governments default more than right-wing governments, and we're going to try to understand why. And we're also going to find that revolts tend to be very much more likely to happen during defaults than during repayment periods. Those are the two takeaways that I want you to get. First, the left defaults more frequently than the right. This is particularly surprising because if we solve a version of the model in which we say, for instance, the left-wing government is always in power, there's no political turnover, or another version of the model in which the right is always in power, no political turnover, they will actually default at exactly the same frequency. This is because we're fixing those two preference parameters of the same values, so they will do exactly the same thing. It is the fact that that we have these turnovers that is creating this differential rate of default between the left and the right. I'll try to go fast. Revolts are more common during default. This is the second takeaway. This is particularly interesting because we're going to find that relative to a version of the model in which we don't let the streets play a role, we just allow for exogenous turnover. There's always a positive probability of a transition between left to right. The baseline model with revolts is going to be able to sustain more debt. Basically, this mechanism that revolts act as a punishment to governments that default too frequently is going to induce some discipline in the governments and allow them to issue more debt at a lower spread and lower the default frequency. Yeah. So these are the two main mechanisms. I have a short two-period version to understand why you have this differential rate of default between left and right. I'm going to try to explain you this one. This is a very simple two-period model in which the probability of default doesn't depend on the incomes. But if you have two parties, one party with has access to a bigger pie than a left-wing party, you would observe exactly as in the simulation I showed you the same default frequencies. So the default probability doesn't depend on Y. But if you allow for some probability of transition, what's going to happen is that if the probability of transition is very low, the right-wing government is going to issue a level of debt that is going to be unsustainable for the level for the left-wing government. And when there is a transition, the left-wing government is going to immediately default after they take power. Conversely, if the probability of default of switching is super high, the left-wing government is going to issue a level of debt that's unsustainable for them because they're going to say, well, don't worry, the right's going to come after me and they're going to clean up. And when that doesn't happen, they end up default. So the same thing is observable in the model in the simulation. This is kind of like what we're seeing, what we have here. This is back to our model. Here we keep you in the sample if you. So we start with a government has just taken office, and here is when a left-wing government has just taken office, and here's when a right-wing government has just taken office. We keep you in the sample if you haven't defaulted or you haven't been flipped, or basically you're still in power, you haven't been turned over by the other party. And we see that a big share of left-wing governments start by a default in the sample, but we don't observe that for the right. But conditional on not defaulting immediately, the number of defaults is kind of the same for both. It's only this initial bump that's driving the big difference. Something famous happening with revolts, but I'm running out of time, so I'll be happy to tell you what goes on afterwards. What's important to see is that this feature of revolts is not necessarily the question of how do you put the revolts and whether or not you allow for revolts only in repayment or in default matters, or whether or not you can sustain more or less debt. We're still trying different specifications of the model and putting revolt costs in different ways. Try to see how each of them can affect the results that we're finding. So in conclusion, this is a model about how political risk and the risk of social conflict can change default and fiscal incentives for the government. We find that left-wing governments exhibit higher default rates than right-wing governments, and that revolts are more common during defaults. And this latter mechanism can potentially allow governments to sustain higher levels, which we find surprising and we're expecting in the beginning. Thank you very much.
Thank you. Okay, so I jump in straight away. I have a point. So first, like from a normative point of view, it seems that any policy that would aim to reduce the social and economic cost of default in a way could be counterproductive because it would increase the default risk according to your story. And second, another comment that I have, I mean, of course, you don't consider that, but your story actually made me think about, rather than the decision of the binary decision of defaulting or not, the decision of how to default, and in particular, the trade-off between soft and hard default. Because the hard default, for example, involving higher haircuts, free up resources that may help buy political support at home, but of course they might worsen the country's reputation. On the other hand, soft default may mitigate the reputational cost, but will shift the burden of adjustment to the domestic population. So if you can have a comments on that. And okay, maybe I have other points, but
No, sorry, should I answer right away? Or should I
no, it depends if other people, yeah.
So thank you, yeah, this is great. Two quick questions. Number one, right, like if I saw this right, in terms of like your predictions for the incidences of protests, right, then there is not much of a difference between right-wing and left-wing governments, if I saw it right. And I was wondering why, like particularly if you're calibrating this to Argentina, right, there might be differences in the mobilization potential, right? One hand, you compare this, suspect that can actually fire up the streets. On the other side, I'm not sure who's going to be in the streets. And then secondly, I'm really finding that the right wing has higher debt, but defaults are less likely than the right wing governments. You argue that if there's a probability of transition, that the right wing government will issue higher debt, level of debt, so that when the left wing government comes in, they will default right away. Whereas if the left wing government is in power, then they just borrow more to retain the effect that the right, at least correctly. If that's the case, I was wondering, why aren't the left wing governments learning from the right governments? And why aren't the voters understanding?
There was, sorry, I think she was, I don't know.
Yeah, please go ahead.
Go ahead. Yeah.
Yeah, I think it's a very insightful idea to differentiate between the right-wing government and the left-wing government. And I'm just like that gentleman. I really like the idea that when you, I was actually surprised by the idea when you showed that the frequency of defaults are roughly the same under the two. And so my question is about the scale of tax revolt, because earlier in one of the charts, you show the scale of the protest go from like 1 people to 1,000 people, depending on the, so I wonder, do you take that into consideration? In terms of left wing, right wing, and then with the same frequency of default, what about the scale of revolt?
Okay, very fast because we have 4 seconds. Matthias. Okay.
You win. Answer that.
So can we really still distinguish between left wing and right wing, especially in the context of Argentina?
Okay. Thank you very much for all of this question. Okay, let's go in order. Okay, so in the model, revolts do imply actual real costs. So there are deadweight losses of revolts. TFP is lower unnecessarily. It's a decision that the households are making to shoot themselves in the foot to create. So it's not necessarily obvious that it's going to be welfare improving to allow for revolts. Now, exposed, the threat of doing that can potentially lead the government to have better behavior and therefore fewer defaults and sustain more levels of debt, which could potentially be welfare improving. So we haven't taken a stand on welfare. We're just taking a stand on whether or not there's more default or less default. Welfare would also matter. The welfare for whom? Remember, we have 2 types of households here. We have the poor and the rich, and those 2 households have different default rules for themselves. For instance, one way of thinking about it is repayment. When there's a lot of debt, will involve a level of regressivity that poor households do not want to tolerate, and poor households would actually be in favor of defaulting, and that's also part of the reason why the left-wing government prefers those types of households to the size of default. So
It's more complicated.
it's more complicated, and it can go both ways. Soft versus hard default. That's a very good suggestion. We could try to see if we allow for partial defaults, if the results will go through. In terms of the reputational effects here, everything is well known, so there's no private information. We're working in a version with potential private information. But there's also forcing to be, we would do the same thing so far. That's it. Concerning revolts by party. The next version of the paper, we're targeting that. We're targeting the number of revolts when the right is power and the left is power. The observing Argentine data is fairness governments tend to create much less revolts than right-wing governments. One way this the model can generate this is through the opportunity cost of revolting. When you have high productivity or the wage losses that you have for losing a day of work is actually going to they're going to be much higher, and therefore an observe fewer revolts more than right. We're just trying to align that with the number of time in office that right-wing and left-wing parties. But that's actually going to be one of the moments that we're targeting in the next version. The defaults by parties are wide on the left drain learns from the right. I think it's an interesting question because, as we said, we give them the same preference and we tell them they're going to be in office forever. They would actually default at the same rates. What we need to understand is that they because of the kind of like the Monica's model, because of their taste for redistribution and how willing they are to go regressive and to impose harsh austerity measures, they can hang out at different levels of that. So the left doesn't want to less from the right because it disagrees fundamentally with the right in the sense that they prefer to have a smaller pie, but a more equitably distributed pie. And it is this tension of when I'm in office, I'm going to do what I want. When you are in office, you're going to do whatever you want. That tends to that combines to create this higher frequency of default and this left to right defaults. Sorry, I may be missing the share of people revolting. Can we distinguish between the right and the left in Argentina? So in the model, all of the poor are the same, all of the rich are the same. We can have we could allow for more for different types. And how do we distinguish between the left and right in Argentina? Is mostly so we have a data set, but that's we don't do it ourselves. But what we tend to observe is when there are governments that are imposing measures that have subsidies, regardless of party affiliations. For instance, in our data set, the Menem government of the 90s, which is classified as a right-wing government, but the same Peronist party in 2003 by the Kirchner is a left-wing government. What we do observe in the data is that right-wing governments, I'm observing with Macri, I'm observing with Milei now, do tend to have higher access to international credit markets, are more willing to go to the IMF, are more willing to issue international credit, are more willing to cut themselves like a handling period, at least at the beginning of the administration. So we do observe more issuances of debt during right-wing governments in that sense. Whether or not they want to issue, which one wants to issue more debt growth depends on who wants to lend them when they're not.
So I think, sorry, to closing your.
We can talk by that later.
Yeah, you can talk by that, but I really need to close. So thanks.
Thanks, everyone. The next section will be in College Nevada, which is the yellow buildings across the road. Thank you. The entrance, the yellow building across the road.